All right. Well, welcome everyone to the Horizon Investments Q4 2022 Market Outlook. Thank you all for being here, listening to the live version of this. And of course, if you are listening after the fact, and as I was talking with Austin beforehand, we are up to 52 YouTube subscribers. So would love to make that 152. So please share this with friends and family. Also, if you have not done so, just hit the subscribe button. And when any of these are recorded and added to YouTube, you'll receive them automatically, along with the short form videos, as I like to call them, the 2 to 3 minute videos that I'll send out about once a month, maybe sometimes twice a month. So Austin Fitch of Horizon Investments joins us again to discuss the, well, as you can see, Q4 of 2022, the remainder of the year outlook. We're going to talk about Horizon's thoughts on the Federal Reserve and their continued increasing of interest rates, or at least the possibility of them. We will discuss inflation, a topic that has come up more and more. And of course, there is no pun intended by talking about it coming up more and more. Its continued impact on markets, and is there a hard landing coming to the U.S. economy, and how global politics are reflected in current markets, because we can never get enough of talking about politics. So Austin Fitch, a chartered financial analyst at Horizon Investments, welcome. And of course, I will take a moment to read this disclosure as it is required by our friends at the SEC, and we always want to be friends with the SEC. So this webinar is created in November of 2022 and is provided by Horizon Investments, LLC, and Tranquilli Financial Advisor, LLC, for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that the assessments here by Tranquilli Financial Advisor or Horizon Investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort level and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or decline in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy. And accordingly, during periods of strong market growth, the account may underperform accounts that do not have risk assist feature. While risk assist was designed with the goal of limiting drawdown, or loss as I like to say, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all loss. Horizon Investments and Tranquilli Financial Advisor, LLC. Thank you, Horizon and Austin, for that wonderful disclosure, and for joining us again to bring the year, we'll say, to a close. There will be an additional conversation on one of these videos. We'll announce that in the next few weeks. But for now, we are so glad to have Austin with us again, who has done a wonderful job of keeping us informed throughout the year. Again, Austin, welcome. Thank you for being a part of this.
Absolutely. Thanks for having me, and happy to be back on.
Great. And of course, a happy Thanksgiving to everyone, my favorite holiday. I know you're traveling, Austin, a couple of different states, and I'll be traveling to New York City to hang out with 4 people that I just love hanging out with, we'll say. So glad to do that. Let's jump right to it. It has been a tumultuous 2022. I will say that Tranquilli Financial Advisor clients, who are clients very frequently of Horizon Investments as well, have been outstanding. They've handled it beautifully. I think with the communications that we presented, with their understanding of the work that we're doing. With all of that said, they still want, and I still want, your outlook for the last, let's call it 40 days of 2022. We've had let's say a run up in the market. I've actually had a few calls. The market is up. Why aren't we up more? And I have to explain the market is nowhere near up, according to Bloomberg.com for 2022. It's just that we're not at the incredibly low points that we were once at. So just give us an outlook at Horizon, what you're looking at right now. How do you bring a year to close like this, like 2022, where it's been so negative?
Yeah, no, it's definitely been it's been a tough year just across the board. And I think the thing, and Lou, I know we'll get into this in a lot more detail. I think the thing that has been maybe most eye-opening is it hasn't just been the equity side of things. You've had the fixed income or the bond side of portfolios get hit in some cases as bad and in some cases worse as the equity side, which again, and I know we've talked about this in the past, but normally when stocks are down 20, 25%, the bond portion of the portfolio is kind of think of it as like worst case, it's flat. But in the 2008 scenario, for example, bonds in some cases were up 20 to 30%. So the ability to kind of offset losses on the equity side with fixed income has historically been something that generally, whether it be portfolio managers or individuals, they've been able to do. This year, it just hasn't been that way. There really hasn't been kind of a place to hide, if you want to think of it that way.
Right. That safe haven has not existed.
Right. Yep, exactly. So going forward for the remainder, whatever we've got, let's call it 40 days at this point. What's the outlook? Unfortunately, it's a little bit kind of more of the same in the sense that it's kind of choppy. We don't necessarily see significant downturn from here, but we think the uncertainty that has existed probably for the last 3 or 4 months at this point probably persists really through, in our view, it's probably the end of January. So that obviously includes the remainder of this year, the beginning part of next year. We think there's definitely still some uncertainty that exists. And that's because at this point, we just need more time. We need more data to really get a sense of kind of what the future looks like from a Fed perspective. And unfortunately, the Federal Reserve in the US is what's driving a lot of this market activity, because what you're seeing is you're seeing a Fed that is raising interest rates at a historic pace. Again, I know we'll talk more about that, but that uncertainty flows through to kind of the ability to price securities, price the stock market, price the bond market for that matter. And we don't see that changing dramatically in the next 2 months at this point. We think that there's, again, not saying that we're down, 10, 15, 20%, but we're probably not up 10, 15, 20%, over the same time period. We think it's kind of choppy sideways. Again, you may be up 5, you may be down 5, but you're not going to rally hard really in either direction is kind of our view.
Okay. And I want to pause you there for a moment because I was bringing up year-to-date stock market charts just so that we could talk about that for a moment. Yep. Well, will be according to Bloomberg.com as of market close 11/21/2022. And I'll get to that in just a moment. My question is this: if we're beginning to trade in a range, and that's what you're talking about, an up 5, a down 5, we're seeing a range of activity in and we're talking specifically about different market indexes like the NASDAQ or the S&P 500. I have to say that I don't follow the Dow on behalf of clients all that closely, because while it looks really good, it's made up of 30 stocks. So it always fits into our portfolio somewhere, I would say, Austin, but it's not something we're tracking. So let me get to the question. The question is this: if we're starting to trade in a range, is that a sign that we'll say down the road, not a prediction of exactly when, but down the road, we start to see that range, pardon the visual, but narrow a little bit, and as it leads us to a market that is more, we'll call it regular from the standpoint of we're not seeing these wild daily swings within it. So the question is, does this range indicate longer term some calming down of the markets?
Yeah, I would say it this way, Lou. It's the first step. And because you could make the argument that we actually started trading in a range as early as this summer. But there was still so much uncertainty as far back as June, July. Like that range was really, really wide, right? Because you had a down 12 and then you had an up 17 and then you were down 10 more. And again, like to your point, like the range is there, but it's just starting to get more and more narrow. I think that continues. So again, we're not thinking that you've got another down 10 or, up 15 kind of in the bag for the next 2 or 3 months at this point. We do think that range continues to narrow as you start to get more and more certainty. But once you really get to that point of a little bit more information kind of in the, out in the, in the market, at that point, that then gives you the footing either to head higher, or it gives you the, added uncertainty to potentially head lower. And we think that data probably is, like I said, like the next, so there's a December Fed meeting, but the next Fed meeting after that is January 31st and February 1st. By the time we get there, you probably have a pretty good idea of at least what direction we're going in once you kind of start to break out of that range.
Okay, now you did not know I was going to do this, but I am going to give you a compliment right now, okay? I recall from our earlier in the year conversations, part of what Horizon Investments were waiting for as we approached the midterm elections, and we will get to that. That's our last topic, talking midterm elections. But you did say at that time that we were looking for more data, and that it really was, with the Fed beginning an aggressive rate increase, the data really needed to be 6-8 months old, if you will, before we could start to make some kind of thoughtful conversation about where it's headed. And I think that's, spot on, if I can dare say that at this point. So let me just mention again, as of market close, November 21st, 2022, the NASDAQ exchange, what would be considered the more technology heavy index, down 29.53%, again, as per Bloomberg.com. That's year to date. The Standard & Poor's 500 down 17.13%, and that's with the recent run-ups included. So if you took some kind of blended look at that, and I do tend to take a blended look at that. You're looking at portfolios down 24% if you were to blend those two equally as an index. That is a significant market loss, and I think we've handled that very well in 2022 from this person's opinion. There we go. That's for compliance. So with that,
and Lou, let me throw one other in there. So we were looking at this just a week or so ago. We talked about the NASDAQ being down. We are looking at a number of different asset classes internally, emerging markets, international markets, domestic markets. The one that actually kind of surprised a lot of us, even internally, and again, we knew this at a high level, but just to put some numbers behind it, the long-term treasury bond, so think like 20, 30-year treasury bonds, were actually down more than the NASDAQ, down more than emerging markets, down more than domestic equities on a year-to-date basis as well. That speaks to kind of what we were talking about earlier. Like normally, the long kind of U.S. Treasury bond would be the position of safety. This year, it's actually been the other side of the equation. It's been more volatile. It's seen more downside, which just makes it really tough when you're trying to think about even a moderate client who's got 60% stocks, 40% bonds. Like, again, where do you go to hide? If you're choosing between something that's down 20 and down 25, like you're going to end up somewhere in the middle, right?
Well, and as I've heard, we'll say jokingly from a number of clients, the mattress looks like a really good place for it right now. And I always say the same thing. Right. No, don't do that. Don't do that. Right. But it is, you can't just brush past it because it's a true comment. It feels that way. Like the mattress would be a better spot for it. So we are going to move into talking about the Federal Reserve, the possibility, your viewpoint, Horizon Investments viewpoint of when they could stop the raising of interest rates. Before we get there, though, Austin, I do feel compelled to just say that it is No Shave November, which is about men's health and cancer. So that is why the beard here. Now, Austin has been rocking the beard for a decade or so. So, but we just overlay it onto No Shave November. So I have a good friend who is in California, and a doctor who really stressed to me a year or so ago, go make sure you're taking care of yourself health-wise. And I can't thank him enough for doing so. I did the routine maintenance, if you will, as I approached the mid-50s. Actually, I should say the later 50s, so I'll admit. And I'm glad he said that. So in honor of No Shave November and all those who are supporting it. So with that, the Federal Reserve, they've been aggressive. I am going to ask you a trick question in a moment. Again, none of this prepared for everyone listening right now and later on. But tell us about the Federal Reserve. Just give us a brief on the before, okay, how we got to this point. Give us some commentary on what they're ultimately trying to accomplish, and where do we go from here?
Yeah, no, I mean, the Fed year to date has done something that honestly, I don't know that, nobody on this call has ever seen it. Probably most of our parents and grandparents haven't seen anything like it as well. They've hiked interest rates more in the last, at this point, you're going on 8 months, than would normally take place over the course of about 4 to 5 years. So the speed and the magnitude of what the Fed has done this year, that actually translates directly into the underperformance of fixed income that we were just talking about. So if we think of it as we came into the year where the baseline, what's called the federal funds rate, think of that as the baseline interest rate that, for that matter, the economy broadly is based off of, right? Mortgage rates are priced off of that. Loans are priced off of that. For that matter, that's the risk-free rate that somebody uses when they try to, try and figure out what the value of a stock should be, right? The risk-free rate coming into the year was basically zero. At this point, you're north of 4%. There is obviously another Fed meeting, as I mentioned, in December. You're likely looking at another 50 to 75 basis points that the Fed will raise that rate again. And then you're looking at the potential for further Fed activity as we get into the end of January, maybe 25 to 50 basis points at that time. So think of it as kind of by the time we make it to the end of the year, beginning of next year, what would equate to basically 1 year's worth of Federal Reserve kind of rate hikes could be north of 5%, could easily be north of 5%, could be pushing 6%. Again, on average, if you look at historical cycles when the Federal Reserve has hiked rates, kind of an average pace has been about 1% a year. And they typically spread it out. Maybe they do, 25 basis points or 0.25%. They do it in, let's say, every other quarter or every other month, to where you're getting maybe 25 basis points. So by the time you make it to the end of the year, it's 1%. Again, kind of fast forward, it would take 4, 5, 6 years to get to where we're at today. That, again, just puts it in perspective. Okay, so what does that mean? Well, that means, again, bond prices have been, falling off a cliff. Haven't seen that in decades at this point. You also have that uncertainty. So we talked about the uncertainty in the equity markets. Think of it this way. If you don't know what the interest rate should be for that kind of risk-free interest rate, which is what stock valuation models are all built off of. If I can't tell you with a high degree of confidence what that rate's going to be, I got no shot at pricing the stock itself or any other asset class. I'm going to ask you to pause
just for a moment, okay?
Yep.
So when you say risk-free pricing,
yep,
just give us a quick version of how you define that risk-free pricing.
Yep. So think of kind of the risk-free rate as, if you're in basically within the U.S. specifically, right? That is the asset that you could buy. In this case, it's a short-term treasury bond, where the risk of default, in this case, we're making the assumption that the government on its short-term, fixed income or short-term treasuries is not going to default within the next, let's call it 30, 60, 90 days. What's that rate that you can receive for giving them, in this case, the U.S. government, their money for a short period of time? Again, coming into the year, that was 0, maybe 25 basis points.
Okay.
Coming out of the year, you're looking at 5%. Like they're going to pay you, now it's annualized, right? So if you hold it for a quarter, you're going to get, a percent and change, percent and a quarter.
Quarter to quarter, right?
Right. But what that tells you is the holding cost for that has skyrocketed. And what they're doing from a Fed perspective is they're raising rates at the speed that they are because that's the tool that they have in their toolkit to fight off inflation, right? We talked about this in the past, inflation being kind of this supply and demand dynamic that was in play. Obviously, coming off the back of COVID, we had this imbalance that was, again, never before seen on that front. What they're trying to do, unfortunately, the only tool that they have is kind of this demand destruction tool where they raise rates to try and basically force consumers to stop, buying things, stop making, businesses to stop taking out loans because all of a sudden, you could get the loan for 2% and now you got to pay 7%. Those are the types of things.
But we were talking about stocks and the stocks looking forward. So our risk-free money is the short-term, let's call 1 to 90 day money.
Yep.
You stated that all stock prices start, or modeling prices start with that in mind. Where are we right now on that modeling? You started to say that it's hard to do, not impossible, but it's hard to do. So how do you model it for the remainder of the year? And the Fed, how is the Fed getting in the way of that model?
Yeah, so this kind of speaks back to that idea of kind of that band maybe getting more and more narrow and with a higher degree of confidence. Look back to where we were 6 months ago. People believed that the Fed were going to raise rates and it was going to stop at 3%. And then all of a sudden it was going to stop at 3.5 and stop at 4. As we talked about, we're well past that today. We're probably going to be at 5.5. What that tells you is that there has been a much higher degree of variability in where folks are pricing or suggesting prices should be from a stock perspective. That's why you've seen the variability and the volatility in equity, in the equity market. Now,
okay, right there.
Yep.
Should they be lower because the Fed is raising rates so aggressively, stock prices, or does it just mean that?
Yeah, where we sit today, it's, I would argue, pretty fairly valued. That being said, again, 6 months ago, there was so much uncertainty. You could argue that the fair value could have been S&P 3,500 or could have been S&P 4,000, which is a pretty wide range, right? Again, that's that narrowing as we're getting a higher degree of certainty because we're getting closer. At least we all believe we're getting closer to the end of this Fed rate hike cycle. What the risk is that the Fed comes out either in December or January and says, you know what we've been doing hasn't been enough. We need to hike rates through the end of 2023. That would be another shock to the system where all of a sudden markets would probably go lower because they would view that as the Fed coming in and kind of forcing that demand destruction even further from an interest rate perspective, which then puts pressure on some of those valuation models that we were talking about.
Okay. And that leads to the question, but you really did just comment on it. Give us the likelihood of interest rate increases, which dominate the news when they come on. What is the likelihood, in your opinion, of the Fed continuing to raise interest rates through 2023?
Yeah, I think, the December rate hike is almost it's a foregone conclusion at this point. The January rate hike is being priced in, so the market expects it, is basically the best way to think of it. Outside of that, the market believes, I would say that we at Horizon would also believe that once you get into the second quarter of next year, that the Fed will probably pause. They'll take a step back. Now, that's assuming that the inflation data continues to trend down like we've seen. And I say like we've seen for the last, 45 days at this point.
Right.
That,
by down,
that goes to the fact
not
that
9%, it's 7.5%.
Right. But that goes to the fact that we need continuing kind of supportive data between now and let's call it the end of January to suggest that maybe we're not at 7% anymore, maybe we're at 5%. Because we have talked about this in the past too. The inflation calculation over time it just mathematically, it's rolling over, like it's coming down. It's moving in the right direction. What the Fed has been doing to some extent has sped up that process. At least that's their intention. We could have a whole separate conversation offline of how well it's worked on the demand side. But that's what we need to see between now and, let's call it, end of January, beginning of February, to have a real sense of confidence that the Fed is going to be able to stop hiking interest rates and, again, kind of pause for the remainder of 2023.
All right. So the next topic is inflation and its continued impact on markets. We really just covered a lot of that. So it's more about the hard landing we'll get to. So and an explanation of it. But before we get there, this is where we'll call it the trick question comes in. Who is the Fed fighting right now?
Who is the Fed fighting?
By raising interest rates so aggressively, who is the Fed fighting?
They're, as I kind of mentioned, they're trying to kill demand. They're fighting the consumer.
Thank you.
Unfortunately,
I knew you'd get it right. You're the first. The first to get it right. Yeah. They're fighting everybody who's on this video conference right now. Everyone who is listening. The Fed aren't fighting some mystery opponent out in the world. They are fighting the U.S. consumer, who is a tenacious buyer of things, and I'm really happy about it. But we love our stuff, and because of it, we are driving up inflation because of that demand that you mentioned during COVID, bottlenecked. So, I mean, significantly bottlenecked. Well, we are the proverbial kid in the candy store, and we're spending, and they are having trouble. They are having trouble rounding the kids up, kind of thing. Is that an accurate depiction of the whole thing? That's exactly right.
They are between kind of a rock and a hard place, and I say that because they have to come out and again kind of fight the consumer. They unfortunately would at this point cheer higher unemployment. Like they want to slow this thing down because of how hot things were running coming out of COVID. Now, again, like you could make the argument that they should have handled COVID differently. You could make a lot of different arguments, but the place that they find themselves in, and we find ourselves in right now, is a place where demand and by default, inflation has been running hot for over a year now. And again, the tool in their toolkit to fight that off is to raise interest rates and to try and kind of create this demand destruction, whether it's, give folks incentive not to spend money or cause companies to, not undertake projects or not hire as many people or potentially lay people off. Like that they need to find that equilibrium, which then goes to, I think, where we're going anyway, kind of that hard landing is like they're really walking this fine line, right? Is you can very easily in some way argue that they've already done it. We just haven't seen the impact of it yet. Push it too far. And then by the time we get into mid 23 or even beginning of 23, you start to see kind of this rollover into, this recession piece that has been batted around for the last, 3 to 6 months at this point.
Some time. We did have an inverted yield curve for not long ago. And for those, just want to define it. Inverted yield curve is your 1 to 3 month treasuries that we spoke about earlier are paying a higher interest rate than your 10-year or longer bonds. I have that correct, Austin?
Yep.
I'm always okay being corrected, but I think I had that. That one nailed. So an inverted yield curve, short-term interest rates are higher than long-term interest rates. You're not getting paid for the risk of buying a long-term bond. Not usually, it does lead to a recession. In all cases, I believe I'm correct about that as well.
It's just a matter of of how long after, right?
That's right. Okay, so with that is a hard landing coming. Define a hard landing, if you would. Define a soft landing.
Yeah.
Which one's coming?
Yeah, I think right. So a hard landing, right, is basically the Fed pushes us too far, too fast, and we end up in a recession. Is maybe the simplest way to break it down.
Fair enough.
Basically, they hike rates so far that all of a sudden business just not shuts down, but it's dramatically
stops hiring people.
Right. Right. You see unemployment start to tick up. You see consumers stop spending, those types of things. Soft landing start to tick up. You see consumers stop spending, those types of things. Soft landing is obviously what they're shooting for. And from a Fed perspective, they want to stop hiking rates at just the right time where they can balance this kind of fine line of the consumer slowing down their demand and their purchasing without businesses completely, again, changing plans, stop hiring plans, laying people off, like everything that potentially comes in a recessionary environment. I think we would make the case that like a soft landing, I won't say it's impossible, but it's pretty darn close. We see more of a hard landing than a soft landing. That being said, not all hard landings look like 2008, if that makes sense.
That's an extreme case, but
right.
Yeah, that does make sense. Yeah.
So I say that because our view is as we get into first part of 2023, you probably do feel some pain in the sense that unemployment starts to tick up a little bit more than it already has. The one caveat there is hiring people coming out of COVID was so hard. I think the statement that we've tossed around internally is you can't fire what you couldn't hire to begin with. So you have a little bit of a cushion there. So that actually helps. But the question is, at what point does the consumer kind of cry uncle, right? You're alluding to it earlier. As a country, for that matter, to some extent globally, the consumer is pretty resilient. And we've seen that so far this year. That's been one of the most kind of confounding kind of data sets. If you look at consumer confidence versus consumer spending, like confidence is in the toilet. Like the consumer feels terrible, right? But they're still doing things. They're still going on trips. They're still,
can't buy a car on the new car lot. Can't. Right.
Yeah. They're still spending money. And that's that fine line is that the Fed's trying to balance is can they slow down that without just completely like eroding it. And I think you are going to see some weakness there as we get into, let's call it the first quarter of next year. But again, we don't view it as like a 2008. We view it as, this thing that by the time we get to the back half of next year, things have probably righted, the ship has been righted. And you actually maybe end up with a better than even average 2023 calendar year. It's just the first half of the year maybe felt more like 2022 extended, but 2023 really kind of takes flight, if you will, as you get into the third and fourth quarter.
Short-term pain for long-term gain. However, It's just painful when you go through it from a stock market standpoint. And overall, consumer debt still remains down. We talked about that last time we were here. Consumer debt as a country remains down. And we're certainly respectful of everyone and what their economic situation may be or wealth situation may be. The U.S. consumer is wealthier than they've ever been from a general standpoint, of course. Again, being very respectful of those who may not be quite as well heeled. So with that, moving into politics, because everything has to end with politics.
There you go.
I said to you before, kidding around, let's talk religion too while we're at it. I mean, why not just touch the third rail over and over again? But politics. So I'll share with you this. I've had conversations with many people about how the midterm elections affect the market, or if one side or the other is in charge of both both chambers, we'll say, or if it's split. What does it mean? And of course, those that are on, we'll say, the winning side feel good about their side, and those on the losing or the other winning side feel good about their side. I try to explain that we, Horizon Investments, Tranquilli Financial Advisor, we care about politics as it applies to the impact on clients' wealth. So what I'm getting at question-wise is this. Do the midterm elections really change all that much from a perspective what Horizon is doing on a day-to-day basis, the analysis of stock markets? doesn't matter which side is in charge or if we have divided as we have right now. How does that impact Horizon Investments' view and the research, the work that you're doing and what you're selecting to put into client portfolios?
Yeah, no, I think that's absolutely a fair question. And I would say you kind of touched on it, Lou, around kind of, do you have an overwhelming majority in terms of, both chambers and in the Democrats' sense, the White House, or do you have kind of more of this split government? And I think that's how we view it, is it not to overly simplify it, but to some extent it is that simple, that if you have one party that controls all three of those moving pieces, then yes, you have, and regardless of which party it is, right now, right, it would be the Democrats in the event that it played out that way, which it's obviously post midterms not going to be that way. But whether in the future it's all Republican or all Democrat in the White House, controlling the House, controlling the Senate, or all Democrats controlling all three, we view that scenario actually as a little bit more risky to markets than a divided government scenario. And here's the reason. And you can make the argument, that this party should be more favorable to markets and business. And that's absolutely, we can make the case on either side of the aisle. But what the takeaway is that when one party controls all three, they can do a lot more stuff. They can pass more legislation. They can, they can have more executive orders that have support. Like all of that becomes in play, which from a market perspective is just more unknowns of what could be coming down the pike, right? So if you think about the midterms, had the Democrats controlled the House, the Senate, and the White House, which again didn't end up playing out, but had that been the case, there were 2 or 3 kind of agenda items that would have been back on the floor that now are not going to ever see the light of day, or at least for the next 2 more years, because with a Republican-controlled House, it's a non-starter. There's no chance of getting certain things passed if you have divided government. So you have this kind of gridlock, which the markets actually appreciate. They appreciate having more certainty and more knowns as opposed to more unknowns and more things that could affect markets because of legislative action that, could be pushed by either party, down the road. So that's kind of our view of where we sit. That being said, obviously, post midterms, we think you're actually in a decent spot from a market perspective because you have that divided government, you have gridlock. Not to say that they're not going to get anything done, but they're going to get a lot less done than they would have gotten done if it had been all one party.
Sure. And back to that, we'll wrap it up right there. We're just at about 40 minutes here, and I'll give you the final word, of course. But I think the point being is that while it could be the Democrats fully in charge, we'll say, or Republicans fully in charge, it just changes the way that you're analyzing things. You're not happy or unhappy either way as an investment firm. You're just analyzing the rules of engagement. Is that a fair?
No, that's 100% fair.
Okay. And with that, I'd love to give you the last word on markets, where we're going. If there's something that we didn't touch on, like digital currency, maybe we'll give it a moment on that. There's no such thing as digital currency currently, but
right, yeah,
on the internet. But so go right ahead.
Yeah, whatever's left of digital currency, we could spend a whole nother session on that,
and we will. How's this? Before the end of the year, I will assure everyone that I will have plenty to say about that, because you go back a few years, Austin, I promised you the last word, but we were talking about it fairly consistently on these video conferences. And I had more than a few clients and friends say, are you getting a lot of questions about buying it? And the answer was always the same. Not so many, but just conversationally, it was there. I think that conversation has ended for some period of time.
Lou, I'll tell you what we've said internally. You've hit the bottom, which we don't think we're quite there yet. You've hit the bottom when Matt Damon comes out and apologizes for being on the commercial that he was on, whatever, Super Bowl commercial.
Yes, completely anecdotal. I have to share it. When I say that I don't drink beer, or if I do, it's every now and then. When I threw my drink, I mean, I didn't want to make a big mess that I had to clean up, but how could someone stand on it? History favors the bold, and they open up a door, and you're like, what are you talking? Is that where you or I? What kind of trouble would we be in? And we deserve it, there's to it. So anyway,
there you go.
We'll get to digital currency, more to the traditional markets. Any
there
final
you go.
words?
Yeah, from a general kind of market perspective, again, we've been around it this whole time. I think our view for the last month and a half of this year is unfortunately a little bit more of the same, in the sense that, market volatility, a little bit of uncertainty. We do think that you're starting to at least get more and more data that's moving you in the right direction of a market that, as we get into 2023, has the opportunity to heal. So I think, but it's not something that we're going to see that take hold this year, unfortunately, because again, if you think back to where we were in May, when the Fed thought that they had inflation under control with one data point, it just takes time to get the data to suggest that, okay, we really have this thing under control from an inflation perspective, right? You're starting to see, the supply demand imbalance really normalize. Like, those are the data points that we just continue to need to see more of. And we can't fast forward that. We can't get the January data in December, unfortunately. Nobody's figured out how to do that yet. So we just have to wait until those data points hit. And assuming they continue to hit in the path of, the trend that we're seeing, then by the time you get to the end of January, beginning of February, get into March, you've got the possibility for things to, you can build a case for a market that, does start to move higher. And can have some legs under it, as opposed to up 5%, down 10%, up 7%, kind of all over the place. So.
All right. So we'll leave it right there, Austin. Always a job well done. For those of you watching or listening to this after Thanksgiving, I hope it was a very nice Thanksgiving. For those of you here now, have a very, very nice Thanksgiving to you as well, Austin, and your family. Travel safe. Let's do it again sooner rather than later, because I really get a lot of great feedback after we have these conversations.
Awesome.
And genuinely appreciate you, everyone at Horizon, and everyone watching right now. Thanks again.
Absolutely. Thanks so much, Lou.
All right. Have a great day.